Where are our politicians? Where are our leaders saying this is enough? We are, for the first time in this country's history, we are setting ourselves up for a condition where our generation, these Generation Z or whatever letter you want to put in front of their name, these kids growing up today are going to have a lower living standard than their parents.
Welcome back to Soar Financially, everybody. Thank you so much for joining us for another exciting discussion here today with Michael Pento, founder of Pento Portfolio Services. And I'm really looking forward to this discussion as well, because we're going to do a bit of a back-to-school discussion. I want to talk about a potential bond market crash, about what Jerome Powell said last week in Jackson Hole as well, how that is affecting markets, and of course, we need to talk commodities. Stifel just came out with some research this morning calling it the structural bull market in commodities is just beginning. So I want to evaluate that a little bit with my guest and to see where things are headed and whether he agrees with some of the ideas they sort of mentioned in the report. So it should be quite interesting. So buckle up. Let me introduce Michael here on the screen. It's a first-time guest on Soar Financially. Excited to have him. Michael, it's good to see you. Thank you for joining us.
Good to be on with you, Kai. Thanks for having me on.
Absolutely. Yeah, we got lots to talk about. Back to school discussion. Let's discuss portfolio strategies a little bit until the year end as well, because there are a lot of moving parts right now. One thing is a recession, for example. That everybody's still waiting for. We'll get to the reasoning behind a recession or a delayed recession. But to start us off, Michael, why don't you quickly give us a summary of the current state of the market, and in your opinion, how are we doing?
Well, I mean, I thought the recession would have started by now in all candor. My big mistake was, whereas I didn't short the market, so let's just get that out of the way. I did not short the market, hoping that we would have a recession starting in early 23. My model, I have a 20-point model, inflation, deflation, economic cycle model. The model said that a recession is coming, but it's not here yet. So that kept me from being short the market. Whereas, to be honest with you, I mean, I totally missed this, NVIDIA AI boom. We are definitely underperforming this year as we really outperformed the market last year. So net, we're still above the 22, 23 performance figures, but we did not participate in this bull market really at all. And the reason is, if I had a introspective look at what I've done, I underestimated the impact of what Jerome Powell did in March of 2023 of this year. It seems like a long time ago, but it really isn't. So what he did by this launch of the bank term funding program was he bailed out the entire U.S. banking system. And he printed $400 billion in the time span of 2 weeks. And I think that's striking, Kai, because when you think about $400 billion, let's put that into some context. The entire Fed's balance sheet, so from 1913, from the enrollment of this putrid organization known as our Federal Reserve, from 1913 all the way to 2007, the end of 2007, the Federal Reserve balance sheet was $800 billion. And then in 2 weeks, in March, they printed $400 billion. Now, I know it's a loan. It's not really pure QE. I call it QE light. But when the Fed bailed out the entire banking system, I think that extended this problem, because a lot of people say that the reason why we haven't had a recession is because, well, don't you know the homeowners have locked in low rates, so they have no reason to refinance. Corporations have locked in very low interest rates, very low borrowing costs, so they don't have to refinance until that wall hits in 2025. All true, Kai, all true. But does anybody ever ask this question? Who owns all of the debt that from 11 of the last 15 years, money was free? And the issuance of collateralized loan obligations, leveraged loans, junk bonds, corporate bonds, investment grade bonds, U.S. treasuries, you name it. All that issuance went through the roof. Unprecedented. $6 trillion in stimulus just in 2 years post the outbreak of COVID-19. Somebody owns some entity or entities owns all of this debt. And you can't tell me that, going from the Fed going from 0% to 5.25%, 5.5% over the course of 18 months didn't render a lot of these institutions bankrupt. Well, it happened. It happened in March. And it would have happened, it would have been a domino effect, replete across the banking system if Jerome Powell didn't do what he did. He said to the banking system, give me all of your debt, all of your mortgage-backed securities, all of your treasury bonds that are massively underwater and putting your balance sheet upside down and rendering you insolvent, and I'll pay you 100 cents on the dollar for that debt. That's why we haven't had a recession yet. That doesn't mean it isn't coming, but it's been delayed.
Yeah, it's interesting because BlackRock puts the risk of a recession in the next 12 months at 20%. Powell says, well, we don't believe in a recession anymore. My economists tell me that there's no recession on the horizon anymore. So it's interesting, right? Because I'm wondering, one point I wrote down is, when do we trust the Fed again, right? As a discussion topic, because we talked about transitory inflation. They've been right to a degree here and reeled it in a little bit. So I'm curious. It's a hot topic. Okay, like I'm going to get a lot of flack for throwing even that question out there.
Don't say the Fed's been right, please. You get a lot of hate mail. Get a lot of hate mail.
That's what I mean. I'm worried about getting canceled here, right? But like, I'm just looking at the actions and where we're at, right? 9.2% last year, 3.2 now, percent in terms of inflation. So the policies like that the Fed has implemented, and it looks like we're going to get a little more, or at least one more rate hike, coming down. Do you agree with that? Like, is the Fed doing the right thing actually, or is it? What are they doing right and what are they doing wrong? Maybe as a question.
Well, this odious organization, I have to say, Jerome Powell, as odious of an individual as I find him to be, he actually said something very honest at Jackson Hole. He actually admitted, it was very refreshing to hear, he's navigating by stars that are obscured by clouds. So he basically said, and I can't believe it's not being made more of a splash in the media. We'll make a splash about it here. He basically admitted he has no freaking clue what he's doing. The FOMC, Federal Open Market Committee, has no clue what they're doing, and they've demonstrated that as a fact over the years. Remember, inflation was transitory. It wasn't really transitory. You have to define transitory. But remember, for years and years and years, inflation was below 2%. They couldn't get it above 2%. Then they got 2%, and the Fed said it went to 9%, but in actuality, it went to 17 or 20%. Now, if the Fed really wanted to make an impact on inflation, and they weren't really in business to protect banks and Wall Street, if they really gave a damn about Main Street, what the Fed would be doing is selling mortgage-backed securities off of their balance sheet, selling them. So home prices, which are up 43% in the last 2 years, 43% home price appreciation since COVID broke out. If they really gave a damn about the average consumer who can't afford rent, mortgage, medical bills, insurance costs, food costs, energy costs, the average consumer with 40-50% of America doesn't even have $400 in savings in the bank. They really gave a damn about them and not Wall Street, they would shrink their balance sheet more aggressively rather than just raise interest rates on the overnight interbank lending rate, because they're raising the cost of personal loans, credit card debt. This is the kind of loans that, adjustable rate mortgages. These are kind of loans that Main Street has. What about Wall Street? Let them suffer a little bit too, because if you talk to the average person like me, who's doing well, we don't feel the pain. We don't feel the pain. But the average person in America is suffering greatly.
Yeah, I keep coming back to something Powell said. He wants something to break before sort of changes course big time. And you brought a credit card debt, unemployment rate to a degree, but unemployment isn't budging. But credit card debt is exploding. It's over 20% interest on credit card payments. That's ridiculous. What do you see as a factor? Like, what would make the Fed change course here? What's your number one factor there?
I mean, Kai, the Fed had a very good opportunity in March to let the market function freely. I mean, why did he have to, in the space of a matter of a few days, he launched the Bank Term Funding Program just because Silicon Valley Bank went under? Why did he do that? Why do we need to protect banks? We actually guaranteed all deposits too. Why did the Fed have to do that? I mean, we have no love or respect for the free market any longer in this country. It doesn't exist. I mean, think about what they're doing with student loan repayments. Look what the Biden administration. I don't care if I'm going to get political. I hate both parties. I'm a libertarian. But why is it okay if you take out a student loan and you have to repay it, because that's part of the deal? That's how the game is played. That's how the rules were set out. Why is it a bad thing if they actually pay down the debt? Because who owns that debt? It's government debt. And where does the government go to get money? It's to the public. So you're picking winners and losers here. And people who actually didn't go to college, right, because they couldn't afford it, or actually saved to go to college, or took out a loan and paid it back, they played by the rules. That's, this is the abrogation of the free market. But that's what you see happening right now. We see the blowback from artificial interest rate repression for years. In fact, if you look at the real Fed funds rate, so this is the real Fed's fund rate, went from -8%, so the Fed funds rate minus inflation, went from -8% in March of 2022 all the way to +2% today. That's a massive rate of change in borrowing costs. And look what's happening because of that. Corporate defaults are up 53% so far this year. If the economy is doing so well, Kai, why are 401k hardship loans up 36% year over year? And as you mentioned, credit cards, auto loans, personal loans, their defaults and delinquencies are spiking. Mortgage rates are now at a 23-year high. The home price to income ratio is at an all-time record high and is even dwarfing that which was seen at the peak of the last housing bubble in 2006. Is it any wonder why mortgage applications are down 30% year over year? Housing affordability. So if you look at the home price in conjunction with the cost of a mortgage, it's at a 4-decade low. These are the kinds of things that don't happen in a free market when money is real, when it means something, right? When money used to be backed by gold, you just couldn't print money. Like, hey, Jerome, a bank went under, Silicon Valley Bank, a very small concentrated number of investors, depositors, way above FDIC insurance, investing in shitcoin. Oh, we can't have that happen. We can't have that go bad. Let's bail out the entire U.S. banking system by printing $400 billion. That's what he did. He said, forget about the discount window. The discount window was always open, right? But he actually had this other program which gave you 100 cents on the dollar, par, for all of your assets. Don't care what they're valued at. I'll take them at par. That couldn't happen in a regime where a currency has backing by specie. Only in a fiat currency regime could that ever be possible.
Interesting. How do you think the banking crisis would have played out if they wouldn't have intervened, if they wouldn't have pumped the $400 billion in there? Like, because there's obviously, right? Oh,
we would. I'm sorry. I'm sorry. I'm a little bit. Maybe
I love it. I want to keep triggering you a little bit here.
I should have had decaf this morning. I should have had decaf. Go ahead. I'm sorry.
No. All good. Like, I'm just curious how this would have played out, because obviously they must have seen some systemic risk. Otherwise, they might not have done that. right? Because it's a
Of course,
fragile system, right?
of course, it's systemic risk. Listen, welcome to the world of banking, where you actually have real money backing a much larger percentage in loans. Okay, you actually have deposits, actual money backing deposits, which has been, hypothecated many times over, not even 10 to 1. So, when you have people taking their deposits out of the banking system, their assets have to be sold in a panic. Okay, but this is just the way the fractional reserve system works. I didn't invent this system. So you have base money supply, which is not fettered by gold, and you have that horrid supposition in conjunction with a fractional reserve system without boundaries. Okay, this is what happens. So you make bad loans, the banks go under, but you don't worry about that, because that's the only way you can return this economy to some semblance of freedom. I mean, don't we want in the end, Kai, sound money, stable interest rates, stable inflation, high productivity? If we want a healthy economy, we have to return to a free market economy. And I bet you none of the Republicans that were on that stage last week really espouse what I'm talking about. Do they understand it? Because if they did, they would have at least mentioned it on that stage. And I'm not just throwing, again, I'm a libertarian, and the Democrats are even worse. But where are our politicians, where are our leaders saying this is enough? We are, for the first time in this country's history, we are setting ourselves up for a condition where our generation, these Generation Z or whatever letter you want to put in front of their name, these kids growing up today are going to have a lower living standard than their parents.
That hasn't happened.
And the reasons why are very clear. I just mentioned all of them to you.
Absolutely, that hasn't happened, and it's a shame that is happening as well. So, just to put a bow around the banking discussion real quick, do you think the banking crisis is contained with that monetary, influx of money into the system? There, is it contained, or do you see that breaking again? Will it pop up again?
Well, the conditions for it to exist, the conditions that caused these banks to go under, are still in place. You have a depositor who is asking the bank, "Hey, listen, I can get 5.5% on a no risk 0 month, 1 to 3 month, 0 to 3 month treasury. I can get 5.25, 5.5 on that. I want you, if you want, Mr. Bank, if you want my deposit to stay there, you better offer me 5.25. And I don't want it in a time deposit. I want it in a demand deposit. In other words, I don't want it in a savings or a money market. I want it liquid, like I get with a treasury." And then the bank says to you, "I would love to do that for you, Mr. Depositor, but my assets are earning 3%. Remember all those mortgages that were made over the last decade and a half at 3 and 4%? All those people are bragging about how low their mortgage is. Those mortgages are the assets for banks, and they're yielding very low single digits. So I can't give you 5.25, because then I will be paying more to my depositors than I'm collecting on my assets, which is a really bad business.
Yeah, that doesn't work.
Business plan. So banks are still having their depositors flee. First, they went to JP Morgans of the world. I have no idea why, when they can just buy a treasury. And as far as I know, and I listened to the Powell-Jackson Hole speech very closely, interest rates, the overnight interbank lending rate is going higher, and that competes with treasury. So treasury yields on the short end have to go higher to match that overnight interbank lending rate. And that means the stress on banks is going to continue. Sorry. And that means that Powell will be expanding at least that BTFP part of his program for quite some time, until the Fed lowers interest rates. And don't forget, the Fed is supposedly still trying to drain its balance sheet by $95 billion a month. They seldom reach that, because as they're draining their assets, as they're letting those assets roll over and not letting those assets mature, not rolling them over, they're also increasing the base money supply when they take in assets from the BTFP.
Got a follow up question there on the bond yield, and it's puzzling me a little bit as well. Why aren't people piling into bonds and T bills right now? As you said, 5.5, 5.25, even the 10-year at 4.2 right now. Those are really attractive rates. What are people expecting or waiting for?
You're talking to a money manager who has about 60% of his portfolio in short-term U.S. debt. So I don't know what they're waiting for. I haven't waited for it. I've been there for a while now. So I guess they're afraid that rates are going to crash. You'd imagine, Kai, if the Federal Reserve, let's just say Friday we have an non-farm payroll report. I don't know when you're going to release this interview, but the interview is being recorded on Monday. So we're going to have the August non-farm payroll report this Friday. You imagine if that number is negative and Powell says, okay, I'm going to start cutting interest rates. He's cutting interest rates. He would be cutting interest rates when the inflation rate, the way the Fed measures it, the way the government measures it, is 50% above their target and rising. That's an untenable position for this Federal Reserve because they don't want to repeat what happened in the 70s. So you have, runaway stagflation, and just destroy the middle class. But if you were alive, and looking at your picture, I don't think you were. It was a really bad time to be alive, economically, very, very painful. Late 70s and very early 80s. So they can't really lower interest rates that quickly. Powell, in my opinion, will be very reluctant, very reticent to cut interest rates significantly. And so you ask yourself, why are you not on the long end of the yield curve too? Well, there's a few reasons why I'm not yet. In fact, I sold most of my long duration assets about a month ago, treasury assets about a month ago. First of all, Japan is relaxing yield curve control. So you're getting a higher interest rate over there in Japan. They used to be 0 to 25 basis points. Now they're heading towards 1%. It's about 65 basis points right now in their 10-year treasury. But that's increased on the rate of change basis, increasing competition for treasuries. That's number one. China, which is also one of the major holders of foreign debt, has to sell treasuries to support their flailing currency, the yuan, renminbi. So that's two reasons. I'll give you a few more. The rate of change of inflation went from 9 to 3, which is good, but now it went from 3 to 3.2. So it's heading in the opposite direction. It's no longer disinflation. It's now a very mild reflation, or at least a stasis in the inflation picture, at least for now. Maybe in the next couple of months that'll change, but for now. And then you have the Atlanta Fed coming out with growth numbers pulling out of their rear end. In my opinion, Atlanta Fed thinks that Q3 GDP growth will be 5.9%. So, that's incredible. So if you have growth is accelerating, according to Atlanta Fed, booming U.S. growth, which is a fantasy, coupled with inflation that's rising, and then Japan and China. Oh, by the way, also we have a massive supply of treasuries coming onto the market too. The issuance through the roof. So if you add those, I think those are 5 factors together, you'll see why you need to just be patient piling into long duration treasuries. I'm going to need to see some kind of fracturing of the employment picture. So a big spike in initial claims up to 275 a week, or a non-farm payroll report below 100,000. That would probably get me more interested in going out a little more on the yield curve, accepting a lower yield, but locking it in for a longer time frame.
Interesting. Yeah, interesting points, because bond market crash is another big buzzword I wanted to talk about. But I want to talk commodities real quick to wrap up our conversation here, because I know you have a hard cutoff here. One of the reasons, or one of the reasons for booming commodity market is looser monetary policy. Stifel mentioned in their report this morning. Did you see a bit of a return of QE coming into the market, especially when a recession comes in? The Fed needs to help out. So I want to tie commodities and the overall federal monetary policy together here as well. Let's talk about that.
Well, as I mentioned before, I think Powell will be reticent to go back to zero in QE. Reticent. In other words, he'll slowly get back there. However, I believe he's proven beyond a shadow of a doubt in his past, since he's been his tenure at the Fed, that he will do anything he possibly can to make sure that banks and Wall Street are protected. And I'll just evidence the Bank Term Funding program once again to you, and with such speed and alacrity in which he entered that program, which opened up, as I said, opened up the discount window, expanded that window at par to take in assets, and guaranteed all the deposits of every institution. That shows me that, you know, when it comes down to it, when push comes to shove, and this economy hits the brick wall, and I have no doubt in my mind that it will, I see Powell going back to first cutting interest rates slowly, then more aggressively, and then going back to QE. He'll say it's temporary. He'll say it's an emergency.
Transitory.
He'll say it's a transitory procedure, but it isn't. Everybody now knows that the asset bubbles have become so extreme. If you look at home price to income ratios, if you look at total market cap of equities to GDP, they're just historically in the thermosphere, the highest level of the atmosphere. And the distortion of interest rates is such that it has encouraged so much debt to be accumulated that the economy just cannot exist. It cannot survive. It cannot function. It's not viable under a regime of real interest rates. Whatever they call the R star. It's just so nauseating. These words that they come up with, these phrases that they invent. You know, the real neutral rate of overnight interbank, like as if they freaking know. Remember, they're navigating by stars that are obscured by clouds, but they somehow are telling you that they are trying to divine this group of 12 people, individuals, you know, the 12 disciples, are trying to tell you that they know the R star, the neutral rate, which is not inflationary or deflationary. They have no freaking clue what that should be, but they pretend sometimes. But in Jackson Hole, he gave you, at least maybe he was drinking that early that morning. I don't know. We are navigating by stars, but we can't see the stars. So expect a shipwreck. Expect the Titanic over and over again.
Just stay true to the theme of our channel here. Should we buy commodities then? Should we buy gold and silver?
Well, listen, I always espouse, Kai, that you should have 5% of your assets in physical gold. And I mean physical gold that you can get access to without anybody else letting you. So no third parties involved. So let's start there. I also feel that you should toggle the rest of your investment allocation in liquid paper. I call it liquid paper gold. So I want gold. I want its ownership to be liquid. In other words, I don't store gold in vaults around the world. That I don't want to call a vault and say, hey, you know, the global economy is melting down. Can I have that gold you have? No, I don't want that. But I call it paper gold because it's really, you know, it's gold. It's supposedly backed by gold, but who really knows? Who really knows if they're going to honor that agreement when push comes to shove? I don't think they will. So I want exposure to the metal, its price appreciation between 0 and 20%, depending on the direction of real interest rates. Now, take together everything I just said in this interview. What do you think is going to happen to real interest rates? Okay, so nominal rates minus inflation. If the Fed were to try to cap interest rates by going into QE as the economy enters into its next recession/depression. And who's going to ever believe that the Fed will allow interest rates to function freely? Like, you know, in Japan, let's just take, I have to mention Japan again. 10-year JGBs yield 0.65%. The Japanese economy is an insolvent island retirement home. Okay. They have 1.54 or 5 quadrillion yen in debt. And their inflation rate, official inflation rate, is over 3%. And the real inflation rate, if you look at the cost of food, is over 8%. Now, Kai, if I told you your inflation rate in reality was 8%, would you lock up money at 0.6% for 10 years? No. I hope you say no, right? So, and everybody else would say no, except for the Bank of Japan. So what I'm saying is the Bank of Japan has decided that they could never allow freedom to price their bond market. And I think that's where we're headed. I think the whole world is headed in that direction, where we have unlimited and protracted, never-ending yield curve suppression, which means nominal yields are capped. And when you subtract inflation, which is going to go higher and higher, real yields will be plunging. So to answer your question, not now. This is not the time to buy. I wouldn't buy base metals or energy here. I don't buy them heading into a recession. And for all those things I mentioned before, we are heading into a recession. It's just been delayed, hasn't been canceled. On the other side of that, after the labor market cracks, after high yield spreads explode higher, after financial conditions, the stress in the financial system soars, then I would definitely be a big buyer of base metals, energy, and of course, adding to my precious metals position.
Fantastic. Michael, being conscious of your time, I really appreciate it. Thank you so much for coming. Where can we find more of you? Because I need to have you back on the program, because we really need to discuss how a bond market crash would play out, what that would look like. You know, going Japan style, let's call it that. Like, what does that look like? Because Japan owns all of its own debt. What does that look like in the U.S.? There's a lot of sovereign debt in the U.S. as well. So sovereign debt crisis is another topic we can discuss. So I'll need to bring you back here very soon to discuss those topics. But in the meantime, where can we find more of you?
So it's the website is pentoport.com. You can go there and you can have a trial subscription to my midweek reality check. It's just a weekly podcast. I give you my thoughts. It's $50 for a year if you want the podcast. Otherwise, it's a free trial for, I think it's 5 weeks. If you're a U.S. investor, has about 100,000 to invest, I'll actually put your money in the IDEX strategy, which is intentions are to participate in bull markets, identify when their existence of a bull market is in place, and then allocate correctly in the right asset classes and stock factors and sectors. And most importantly, and it did a really good job in COVID. It did a really good job in 22. It identifies when the recession, because that's when you really want to avoid investing. That's when you lose half of your money. When the recession is nigh, when you're heading over the waterfall, that's when really bad things happen to banks and credit markets and assets all over across the board. We actually hide in something called the 4 horsemen of the economic apocalypse, which I've dubbed them. So it's cash, and it's treasuries, it's the US dollar, and it's shorts. Those are the 4 things I own. Sometimes a little physical gold too. But I call it the 4 horsemen. That's where you want to hide out. So you can actually not only not lose 50% of your assets, as you've done over and over and over again in recent history, 30 to 50%, but maybe even make some money in the next collapse. That's the goal. And then again, identify when that's over, when you've reached a fair price, a valuation that's not 170% of GDP, which is like ridiculous, when the average of that ratio is more like the ratio I'm talking about is the total market cap of equities to GDP. When the averages are like 75%, not 170, when you get a nice dividend and prices are fair, that's when I'll go back into the market.
And Michael, really appreciate your time. It was great having you on. Definitely need to do a follow-up discussion with you before the year is over to see where things are headed. Really appreciate it. And again, thanks so much for coming on. Everybody else, thank you so much for tuning in. We hope you enjoyed this discussion here with Michael Pento on Soar Financially. If you haven't done so, because I know 80% of you watching are not subscribed to this channel, there's a subscribe button right there. It's a rectangle. Hit it. We really appreciate it, so we can bring guests like Michael and other great, great minds in the financial world on this channel to discuss what is going on, to give you information you might not hear on Bloomberg and other financial media. Really, really helps us out. Really engage with us. Let us know your thoughts below. Hit that like button, and we'll be back with lots more content. Thanks so much for joining us.